What's up, guys? Welcome back to another episode of Behind the Facade. I'm your host, Gavin J. Gallagher, and on this podcast I explore the mental and emotional game often playing out subconsciously in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset, your behavior, to take control of your thoughts, your emotions, and most importantly, your ego. So here we are on episode 70, and last week I was speaking with former opera singer turned property developer Joshua Benaim, who's based in New York City and has a development business called Area Living or Area Property Development Group, I think it is. And interesting conversation last week, and I found it kind of interesting how you can go from being a opera singer performing at the Metropolitan Opera in New York City and end up a pretty decent developer building, or apartment buildings all over the US. And so it just shows you how a little bit of resourcefulness can kind of get you on a different path. And this week I'm going to be covering a question coming in from one of our listeners, and the listener's name is Sean, and Sean is a member of our Facebook community. But the question is in the area of property investing and taxation and whether it's all worth it. And the reason he wanted to kind of me to ask that question is because I'd actually put it out there that I was going to be doing a thing called the Elite Property Hour, which is basically a free training that I gave last week, and it was a Zoom call, and it was actually very well received. About 42 people signed up in advance for it, joined the call, and just basically were present while I was giving a sort of a group session on property investing and how to go about it and things like that. But some of the questions that came in advance for me to cover during the training one of them came from Sean, and it was that, particularly in the Irish context with buy-to-let investment and stuff, the taxman takes about 50% of the rental income that you earn. And he just wondered out loud whether it is worth the hassle, what's the point of starting a property portfolio if you're going to have to give away half of your income to the taxman? And he just wondered, was it all worth it? So I'm going to be going into that today. But just on that whole point of the free training that I gave, the Elite Property Hour, as I am calling it, if you're interested in learning more about that, you can actually watch the playback of that video if you are a member of the Behind the Facade community, which is my Facebook group. And you can just click on that to join it, and I'll let you in. But there will be more of these free trainings coming up, and so I would be delighted to have you attend them if you're interested. And it doesn't cost a thing. All you have to do is register in advance. So if you're interested in learning more, stay tuned by joining the Facebook community. And once you're in Behind the Facade community, you can just wait for the announcement. But I am looking at doing it possibly on a weekly basis. It's just 1 hour, and it'll cover sort of, I suppose, 30 to 40 minutes of training session from me, followed by a Q&A, and you can just basically ask any question that you have. And it could be anything to do with something you're dealing with at the moment in a property investment, or you're trying to get started in property investment, whatever it is. It's a good forum to table any questions that you have. So just keep an eye out for that. And by all means, please do join the Facebook group. So let's get into the question of the day. And that is, with all the taxes that we pay as landlords, is it actually worth it? Is it worth all the hassle to go out there and to become an investor or a landlord? And predictably, my answer is yes, but I do appreciate the frustration, and I can understand why people would question it. And it's funny, I've heard over the years, I've heard different feedback and pieces of advice, and people would actually prefer to do an investment that pays no tax than an investment that pays tax, regardless of the outcome. So if I told you that you can make €600 or 600 whatever, but you'll have to pay 50% tax. Or you can do this other investment and earn 250 in tax. Earn 250 in total, but not have to pay any tax. A lot of people will choose the the 250 with no tax rather than the 600 with 50% tax, just because they dislike paying tax. And it's kind of an unusual thing, whereas the outcome would obviously be better if you just simply pay the tax and end up with more in your pocket. But we're going to get into that. That is a little bit around some of the mindset around taxes and stuff like that. But like the reality is yes, you know, it is worth it, because, you know, you've got to get started somewhere. And of course you can go and you can look for ways to minimize the tax. But unless you actually are prepared to go out there and do it in the first place, you're just never going to make, you're never going to get into this game. You know, if you're going to wait until taxes fall, or if you're going to look for ways to exclusively do a deal that doesn't pay any taxes, you could be a long time waiting around. And it's just important to get started as early as possible with whatever resources that you can muster. And so why do I say that? Well, I'm going to go into some statistics, and I did cover some of this last week on the free training. So if you were present for that and you're listening in and this seems a bit repetitive, my apologies. But there is a lot of scary statistics out there at the moment around pension provisions, particularly in Ireland and the UK. And both of these countries have got what we call a state pension. And that is what people have as their kind of last resort in the event that they reach retirement age, which is about 66 years of age, and they have absolutely no savings or investments to their name, and they basically need help surviving for the rest of their old age. And the reason they need help is because they are, you know, they're at that age where you either can't get a job, or you're kind of getting old and frail and it's hard to actually maintain a job. So you need to fall back and have the support of a state pension. And it is not something that you want to be relying on, I can assure you. If you're looking at the UK as an example, the UK state pension, from what I've found on the internet, is £159.55 a week. And that is from the age of 66. Now that is actually, you will not be allowed to earn that until the age of 67 by 2026. They're actually increasing that in 2026. Now in Ireland, they actually pay what sounds like a higher rate, but I'm not sure with the exchange rate and the cost of living and stuff whether it is, but it's €248.30 per week. And that is, you're eligible at the age of 66 for that. But then that is actually changing. So in 2001, so this year, that is going to be increasing to 67 as an age. And then that will actually further increase. So you will not be eligible for a state pension until you reach the age of 68 by the year 2028. And €248 a week is not a lot of money. Anybody who's out there, you know, shopping for groceries or buying petrol for your car or anything like that will know that it will not go very far. And I don't know, I can't speak myself, but I'm sure anyone who's in the UK knows that £159 is just not going to get you very, very far. Now imagine for a moment that you have, you know, lived a long life, you've worked all of these years, and you're now in your 60s, your mid 60s, and you are facing into £160 a week or €248 a week for the rest of your life. I mean, could you do that? I mean, that is just, can you even cover your basic outgoings at that rate? For most people, I would say it's going to be a struggle at the very minimum. And who wants to feel that sense of barely surviving in your sort of twilight years? I mean, that is just going to suck. And the reality is around 30% of the population in the UK have no pension provision whatsoever. And that is what they are facing for their final decades of their life. That equates to more than 15 million people living on £159 a week. Now, here in Ireland, they actually did as part of the census that they did in 2019, I think it was, they came out and they asked anyone who was working what were their pension provisions looking like. And 6 out of 10 said that they had no pension provision. and that they were going to be relying on the state pension. That is 60% were looking at relying on the state pension. Now, remember, the state pension is €248 a week. So that is going to be a pretty miserable existence for the last how many years that you have left. And don't forget, because of medical advances and stuff, we're all living that little bit longer. And I think as we age over the next these particular decades that we're in at the moment, there's so much innovation around health and everything like that I actually think that the normal healthy lifespan is going to extend from where it is today, like in the 70s or whatever, that it'll actually probably become your 80s and possibly even your 90s as a kind of a standard lifespan. So you're talking about surviving 30 years as a pensioner, and you've got to make sure that you have the provisions to do that. Now, let's just assume that you're a little bit sort of smarter and better prepared, and you have some pension provisions. But that does not make for hugely reassuring reading. I've just been looking at the figures today, and the average UK pension is just £50,000 saved away. Whereas in Ireland, the average pension, private pension that would be, is on average €90,000 stashed away somewhere. And now I understand that these are average figures, and so there could be some people on much, much higher figures, but that's going to be balanced out by a lot of people on much, much lower figures. So if you're looking at, less than 90,000 sitting in your sort of pension fund by the time you reach 65, you're not going to be in great shape. And the reason I say that is, here's a figure for you. Taking 30 years as the lifespan, the lifespan that I would predict that most of us are looking at. If we're healthy now at this age, then by the time you reach 65, you are going to be probably in a position to live to another 30 years. So 95 would not be beyond the realms. Over the next 30 years, I can imagine medical science and innovation and all that is going to extend our lifespan by at least 15 more years. And so what do you need to survive 30 years? Well, let's just assume that you can get 4% on your annual 4% annual return on your savings. If you have got 500,000 sitting in your pension fund and it is yielding you 4% a year, then you have got 30 years, provided you do not draw more than 20,000 a year. Now 20,000, it doesn't matter what it is, that equation works for euros, works for dollars, works for pounds, works for any currency, because it's just basic math. 500,000 at 4% per annum over 30 years will allow you to draw 20,000 per annum until it's completely gone by the time you turn 95 or 96. Now that equates to 385 a week. That sounds a lot better than the state pension, but still not a lot to write home about. So really, in my opinion, you've got to be looking at a net pension provision of at least $1 million to be in some way comfortable in your retirement years. Now 1.5 million would be kind of where I would see as the absolute minimum. And the reason I say that is just 1.5 million will last you 30 years, drawing 60,000 a year, which is 5,000 a month. Now, by that stage, you would hope that you have your mortgage paid off, and you would hope that your various expenses, like your children are now in school and they're paying for themselves and they've got their own accommodation and all that kind of stuff. You would hope that all of that's under control. So 5,000 a month would be, possibly able to maintain the average salary that people are retiring on. And I would hope that you're doing an awful lot better than that, but let's just use that as a minimum. That's 1.5 million sitting in your pension. And remember those figures, that the average today is 50,000 in the UK and just 90,000 in Ireland. So we are so far out of having a comfortable retirement. That is the reason why I really think it is so important that you get started on the journey of becoming an investor as soon as possible. And I'm not going to necessarily push you into, property investment. it could be anything. Like if you go and decide that you're going to specialize in investing in stocks and bonds and things like that, well then go for it. But just get started on something, and preferably diversify so that you have a little bit of everything. So I would certainly recommend that you have a stock market portfolio and a property portfolio, and you also have a nice big healthy buffer of cash. And while you're at it, go and have a pension as well. Like if you have a company, if you're going out there and you're earning money either as a worker or as an entrepreneur, you can create a pension, and you can actually have that pension working for you while you're also investing in these things in your own personal name. And obviously if you're investing in your personal name, you're paying tax. If you're investing through your pension, you pay zero tax. So there are most definitely benefits of doing it through a pension, but you don't get to touch it until later. So if you want to have any kind of lifestyle in between now and your retirement years, it might be an idea to get into a little bit of it in your personal name as well. So you can see the importance with all of those figures that I quoted. I mean, just get started, get it as early as possible. And I know a lot of people, what they kind of think is that, well, I do understand that it's important to get started, but just not right now. Maybe in a year's time when I've got a raise, or maybe in a couple of years' time when I buy my own place. And I understand that feeling, and I've done that myself. And it is, if we're completely honest with one another, we're fooling one another. We're just falling for this thing you call a cognitive bias. And the cognitive bias in this case is restraint bias. And that is, we all have this tendency to overestimate our ability to control impulsive behavior. And you should be saving your money and putting it into a pension, but temptation gets in the way, and you suddenly make that impulse purchase, whether that's you change your car, or whether you buy that nice holiday, or whatever it might be. And I don't fault anyone for doing it, but that is the problem, is that temptation dangles right in front of your face. And even though you know that you should be putting this money away for your pension, you just spend it at the time. And because of that, most people are underperforming in terms of the amount of pension that they have put aside. And it's a big problem. And so unless you're actually kind of hyper disciplined person and covering it away, you're going to find that you're going to be short of your pension. And so it's important to get started saving and investing. And so just my biggest suggestion is just to get started. Even if you don't think you can afford it, start putting something aside so that it becomes like a habit. And try to create like a weekly saving habit, monthly saving habit. Get it out of your hands. Don't have it sitting in your main bank account that your credit card is attached to. As soon as you get paid, that money should be just whipped straight out of the account and go into some sort of a deposit account that you can't easily reach. And that will just get that discipline going where you suddenly can start putting money aside. Now, is it all worth it if you have to pay tax at the end of the day at around 50%? Well, yes, because that is basically the cost of entry to this game that we call property investing. If you want to save, you want to invest, then you just simply have to accept that tax is a fact of life. And there's an old saying that there's only two things guaranteed in life, and they are death and taxes. And the bottom line is taxes on your income are a bummer, but they are at least it's proof that you're actually earning something. That the fact that you have to pay some tax means that you're earning something in the first place. And the good news around some of the taxes on income and stuff is that at least you can deduct your expenses. Now, this wasn't always the case. Certainly here in the Irish market, if you go back a couple of years after the recession or during the recession, they were so against property investment and speculation and stuff that they actually tried to prevent people. They had to make it really, really unattractive. So what they did was they wouldn't even allow you to deduct your interest payments on your mortgages and stuff. So if you were earning so much per year, you'd pay 50% tax on that before you deducted your mortgage. And so you ended up, with almost having to put money in just to keep an investment going. And that was a completely unsustainable. And so thankfully they've done away with that. But there's got to be ways that you can minimize your tax. And that is one of the ways is to actually create like a pension fund and to invest in property through the pension fund. But there's various other ways to do that. And there are drawbacks to having it sort of locked into a pension. First of all, you do not know if and when the government could decide to change the rules around pensions. And I know that I've been involved in an investment fund over the last 15, 16 years. And that investment fund, when we invested in it, was producing everything that was all income and all gains were taxed 23%. Today, the very, very same income and capital gains are now taxed at 60%. So it's and the money is locked in there. So it's very, very unattractive now. And if we had known then what we know now, we probably would have never have done it. But that is one of the facts of life, is that legislation can change these things. So it's not something that you can absolutely rely on for the rest of your life. And so it's always good to have a bit of diversification out there. So my preference would be to have a portfolio of property in my personal name, portfolio of property through a pension, maybe own some stuff through a company as well that has, if there's any element of risk that could take down your portfolio, then you want to ring fence these things so that they are not cross secured and they won't take one another down in the event some sort of fall in value happens. So you got to give careful consideration how you structure your investments. And the reason I say that is because you can create huge savings in tax just by being careful the way the property is owned, whether that's in your personal name, whether that's structuring it from the outset so that the development that you're doing ends up in your personal name. There's various ways to do it. So this is one of the things that I actually cover in my mastermind. I was asked this question just last week by one of the members, and we were going into the different ways that you can structure your investments and that you can kind of map it out right from the word go, so that the outcome is that you end up owning the property in your own name, but you have avoided all the taxes that would have been taken had you gone about it in the traditional way. Anyway, inflation is another reason why you need to be doing this, because inflation is eroding the value of your capital or your cash right away every single day. And at the moment, we've been living in a low inflation environment at around 2% a year. But that is starting to change, and I can actually see us entering into a period where inflation creeps up on us, and primarily because of the money that has been pumped into the economy because of COVID. And so we could be looking at a slightly higher inflation rate, if not, a fairly mean inflation rate. And if that was the case, then every single penny you have saved up in the bank is just losing every single year. And you could be looking at 5% of your money just disappearing in terms of erosion of value over time. And the other thing that is damaging your cash at the moment, if you've got something sitting in the bank, is negative interest rates. And now, depending on where you're listening to this, wherever you are in the world, that may not be an issue for you. But here in Ireland and the EU, we currently have negative interest rates. And so if I put my money in the bank, I am not actually making any money. I'm not even earning zero. I am actually having to pay to save my money in the bank. And so it makes 0 sense to have a whole load of cash sitting in the bank there, other than as some sort of a rescue buffer. And I do recommend that you always have some sort of a safety buffer in the event that something happened, in the event that you lost your job, in the event that the recession sort of suddenly takes a turn. You need to have 6 to 12 months of cash just sitting there so that you can survive. And that puts your mind at rest, and you can kind of sleep easy, not worrying about what if. And so that is it's a bit of a habit that I've picked up over the years, and it's something that I strongly recommend everybody else does, because it just makes you a better investor when you don't have to think about releasing cash urgently because of some sort of event that's taken place. Always be putting money aside in a kind of a separate fund. So there's a lot of different ways to make money, and most of them involve exchanging your time or your sweat for money. But with property investing and with stock market investing, all of that kind of stuff, you eventually end up earning passively. Once you get to a certain size, the cash that's coming from the income on your investment actually goes into giving you this passive income, and that is something that is very, very attractive as you grow your fund bigger. And through compound interest or compounding in general, you can end up that the income coming from your investment ends up being very substantial, and it could end up that every year you are earning more in a year than the initial sum that you actually put into your saving in the first instance. So this is something that I think we all want to be striving for. You want to be striving for a diversified portfolio of assets so that you're sitting there, you've got, and I'm talking about really diversified, like you might even go and put a certain amount of your portfolio into cryptocurrencies. You might put a certain percentage of it into the stock market. You might have a certain amount of it in funds, private equity. You'll have a certain amount of it in property related investments, and you will have whatever business your income is coming in from. So you'll have your own pension. If you have a business, you can actually chip away some of your profits and throw them into a pension fund, and it's a very efficient way to actually bring down the tax on your business. If you don't need access to that cash, well, then you can just stash it into your pension. It's completely free to do that. So I do suggest you read up on this kind of stuff. No matter where you are in the world, this is something that is important to know. So you should definitely go and find somebody in your local area that is talking about this kind of thing. Whether it's these books, I see these books every year, they come out, and it's the tax guide or whatever it is, and they just point out the various taxes that are out there, and it's worth reading those because they can give you pointers, and you can hire somebody that can actually help you structure your property investments when you're making these investments. So that's it, guys. I think I'm going to call it a day there. It's episode number 70. I hope you enjoyed this week's episode of Behind the Facade. Thank you so much for listening. As always, my number one ask is for you to leave a review or indeed share the episode out with someone you think may benefit from it. In the show notes, you will find links to the various things discussed today. And if you have any questions or topics you would like me to cover in future episodes, please connect with me via the Facebook group Behind the Facade Community. Alternatively, you can reach out to me on social media using the handle Gavin J. Gallagher, and this includes my YouTube channel. Lastly, you can stay up to date with the various things I am working on by adding your name to my email list, which you will find over at gavinjgallagher.com/go. All right, folks, that's all for now. See you again next week.